Hey everyone, welcome back to Corporate Decoder. Today, Peraso Inc. PRSO just filed a Form 8K detailing an adjustment to a stock purchase agreement, and I'm seeing a familiar pattern playing out. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company adjusted a discount on stock purchases, and it reminds me of other struggling tech companies trying to stay afloat. Alright, so what we have here is a current report from Peraso Incorporated filed on the 10th of July 2026. This is essentially an update filing letting the public know about something important that happened. The main event in this filing is about an agreement Peraso Incorporated, or the company as they call it, made with Roth Principal Investments Incorporated. Think of Roth Principal Investments as a financial backer. They had a deal already in place, a common stock purchase agreement from the 30th of June. This new filing is about a letter agreement, essentially a tweak to that original deal. So what did they change? They adjusted the discount on stock purchases that happened before and after the market is open. This discount is now set at 5.0% of the VWAP, which stands for volume weighted average price. Basically, Roth Principal Investments agreed to buy shares at a slightly smaller discount than they originally planned. The original deal terms are still in place for everything else. This filing includes the letter agreement itself as an exhibit, which is Exhibit 10.1. This is where you'd find all the exact details if you wanted to dig deeper, but the core takeaway is a small adjustment to the discount on stock purchases. Now, why is this interesting? Peraso Incorporated is a technology company, specifically in semiconductors, with a pretty small market cap of about $11 million and only 42 employees. Their stock price has been pretty volatile too, trading between 73 cents and $2.37 over the last year. They're considered an emerging growth company, and filings like this often signal a company trying to shore up its finances or find new ways to fund operations. Their common stock trades on the Nasdaq under the ticker symbol PRSO. The market is watching this company closely, and events like this, even seemingly small ones, can sometimes be indicators of their financial health. This kind of adjustment to a stock purchase agreement, especially with a smaller company, often happens when the company needs cash and is relying on investors like Roth Principal Investments to provide it. By adjusting the discount, Peraso Incorporated might be trying to get a slightly better price for their shares when these purchases happen, or it could be a gesture to keep their financial partners happy. Let's look at some recent news around Peraso Incorporated. There was a headline on the 10th of July, the same day as this filing, saying Peraso Incorporated resets VWAP discount in Roth equity purchase agreement. This confirms that this event was publicly noticed back in May. They had a Q1 earnings miss which sent shares plunging, and even very recently, on the 11th of July, the stock was tested at key support levels. This overall picture suggests a company that might be under some financial pressure, and these agreements are part of managing that pressure. There are some institutional investors holding shares like Geode Capital Management, Vanguard Capital Management, and State Street Corporation, but their holdings are relatively small percentages of the total shares outstanding. This indicates that no single big player is heavily backing the company, making these types of agreements with financial partners more critical. What I am seeing here is a company that is likely trying to raise capital through these equity purchase agreements. The adjustment to the discount might be a minor concession to keep the funding line open. For smaller tech companies, especially in the semiconductor space, maintaining cash flow and access to capital is absolutely vital for research and development, as well as day-to-day operations. Historically, when smaller companies have to make these kinds of adjustments to their equity financing deals, it can be a sign that they are struggling to secure funding on more favorable terms. It is not necessarily a death knell, but it is a development to watch closely. Think of it like adjusting the interest rate on a loan when you are having trouble finding a lender. You might get the money, but it comes at a slightly higher cost. The risk I am watching is whether these equity purchase agreements are enough to sustain Peraso Incorporated through its current growth phase, or if further dilution will be needed. What I'm actually looking for is evidence of improving operational performance offsetting these financing adjustments. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this breakdown helpful, please like this video and subscribe for more. Let me know your thoughts in the comments. Check out our Discord community linked below.